Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Sunrun stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 3.3 billion market cap. They're trading at $15 a share and they have 221 million shares outstanding. Sunrun designs, develops, installs, sells, owns, and maintains residential solar energy systems in the US. They sell products such as panels and racking. In addition, the company offers battery storage along with solar energy systems, and they sell services to commercial developers through multifamily and new homes. Their primary customers are residential homeowners. They always have a stand at my Costco trying to sell their product. They were founded 17 years ago in 2007, headquartered in San Francisco, California. There is more energy from the sun that falls onto the earth in 1 hour than is used by everyone in the world in 1 year. Isn't that an amazing stat? Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. This doesn't look good. Negative free cash flow, and it gets worse from 21 through 22 through 23. It is a little better from 23 to the trailing 12 months. But still, negative 3.2 billion is not good. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year and getting worse, from negative 1 billion to negative 2.6 billion. Revenue is the sales for the company, and that's okay. It goes from 1.6 billion to 2.2 billion. They do have a really good price to sales ratio. Price to sales is stock price over sales per share. So they're at about a 1.5, 15 over 10. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 22 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of negative $19 billion. We divide that by 221 million shares. And we get a calculated stock price of 0. They're trading at 15, so they're trading at a 100% premium. It's a big sell according to the model. I looked at multiple models and multiple scenarios with this company. I don't see a situation where they could become profitable at any point. That doesn't mean you can make money shorting them, because they could go bankrupt in 5 years and 15 years. As long as they get funding, they can stay around. So you never know when it's going to drop. It could actually go up. It could go up a lot. But if they never become profitable, at some point, they're going to go out of business. Maybe they'll get acquired by another company, but that's unlikely. There are 26 companies in the same industry as Run, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx, 2.6 billion. That's the investments in property, plant, and equipment. They're pretty leveraged, 2.2 debt to equity ratio. For every dollar of equity, they have $2.20 of debt. They lose the most cash out of any company on this list, almost their market cap. They rank 4th in market cap. They have a good price to book, but we can't look at their PE or price to free cash flow since it's negative. A good price of sales, 1.6. So they do generate a lot of revenue relative to their market cap. You can see they generate more than Enphase, but Enphase is profitable. They're generating cash. Revenue is meaningless if you can't generate any cash. And they're still growing. Their 5-year annual revenue growth rate is 21%. Look at Beam, 73%. If you put $10,000 into this company when they started trading in 2015, at one point you would have been close to $100,000, but you would have come way down to $17,000. Still a 70% return. Let's take a look at their most recent 10Q. This shows us the first quarter of 2024 versus the first quarter of 2023. This is their income statement. Next, we'll do their balance sheet, then their statement of cash flows. Revenue is down. It was almost 600 million. Now it's closer to 450 million. Revenue is up from customer agreements and incentives from 250 to 322 million. But solar energy systems and product sales are down a lot from 340 million to 135 million. Because a lot of customers don't actually pay for their solar outright. They pay for it over time, kind of like a lease payment. Within a year of buying my home, I got solar added. I paid for it outright. I got a tax deduction, but my energy bill was so expensive before. It was almost $500 some months. I couldn't believe it. So I think I broke even after like 3-4 years. It was totally worth it. Let's see if they give a breakdown of the revenue. Here's the only breakdown they give. Of the $458 million, $323 million is in customer agreements and incentives. $304 million customer agreements, that's up 35%. Incentives, $19 million, down 12%. Then you have solar energy systems and product sales. Solar energy systems, $65 million, down 72%. Products, $70 million, down 39%. They increased $79 million in customer agreements. Let's see what they say about it. The $79 million increase was mainly due to new systems placed in service, plus a full 3 months of revenue recognized in 2024 for systems placed in service in the first 3 months of 2023, because they get paid over time. Like I said earlier, people don't always pay upfront for their solar. They pay for it over time. I remember a Sunrun guy came to my house trying to sell me solar. I already had solar, but I told him the company was in such bad condition financially. He was really shocked. I told him about my YouTube channel. He said he wanted to check it out. In solar energy systems, it went down $164 million. That's right here, $164 million. And this was due to an increase of customers choosing to enter into a customer agreement versus purchasing a system outright, which we did see. Customer agreements went up, but it didn't go up nearly as much as this went down. And they said it was likely due to higher interest rates. Product sales decreased $44 million. That's right here, $44 million. Due to lower average sales price of solar energy products, as well as lower sales volume of solar energy products to installers of solar energy systems compared to the prior year, due to easing of supply chain constraints. Let's look at their operating expenses. This is back on their income statement. Cost of customer agreements and incentives, $269 million. So revenue, $323 million. Cost of revenue, $269 million. So there is some profitability there. Cost of solar energy systems and product sales, $156 million. That's based on revenue of $135 million. So they're losing money every time they sell their products. And the reason they're losing even more money is because of the sales and marketing, $152 million. They also have general and administrative expenses, $51 million, R&D, $12 million. So their total operating expenses are much higher than their gross profit. That gives them a loss of $183 million. A little better than last year on a loss of $228 million. They have a lot of debt. They pay $192 million of interest on their debt. That gives them a net loss of $283 million, better than last year of $335 million. This is only for 1 quarter though. Loss per share of 40 cents. And they're diluting shareholders. It was $215 million last year, now it's $220 million. Let's look at the balance sheet. Current assets, $1.7 billion. Current liabilities, $1.3 billion. So their current ratio is above 1. So it looks like they'll be in business for another year. Cash plus restricted cash, $800 million. And this is their statement of cash flows. Operating cash flow, negative $140 million. So they have about 6 quarters of cash runway. Their total assets are $21 billion. A little more than last year. Their biggest asset is solar energy systems, $13 billion. Here's a breakdown of the $13.4 billion. Most of it is equipment, and then $2 billion of inverters and batteries. That totals $15 billion, but they depreciated $2.3 billion. Plus you have to add $700 million for construction and progress. They have $14 billion of liabilities, more than last year of $13.5 billion. Their biggest liability by far is long-term debt, almost $10 billion. Assets minus liabilities equals equity, $5.2 billion of equity. They raised $6.6 billion from selling their business. They lost $1.5 billion from running their business. Let's look at a statement of cash flows. The first section is operating cash flow, which is a negative $140 million. Better than last year, negative $439 million. They had a $150 million swing in inventory. Last year, they spent $100 million of inventory. This year, they had a cash inflow of $48 million in inventory. That means they sold $48 million more of inventory than they bought. In their investing section, they spent over $500 million in buying solar energy systems. There's a lot going on in their financing section. They had a cash inflow of $470 million. They have a line of credit they borrowed on. They also paid back on that line. They borrowed $440 million on a convertible note. They paid down some of that note. They have some non-recourse debt of $770 million they added. For example, most home loans are non-recourse, meaning if you default, the bank can take your home, but they can't sue you and take other property. A cash inflow of $160 million. This is contributions from equity holders. Let's look at a company on Simply Wall Street. Its last price $13.45, $3.2 billion market cap, down 7% in the past week, down 28% in the past year. They started trading back in 2015 at about $12 a share. Its low point was in 2017, below $5. And then it 20x'd from $5 to almost $100 in 2021. But it never got that high again. It's only been downhill since that peak, coming all the way down to $15. They have a lot of headwinds, so the downside is much greater than the upside for this company. Simply Wall Street doesn't even value them. That tells you something. 25 analysts priced this stock at $20. They say it's undervalued. Their revenue forecast for this year is $2.1 billion, next year $2.5, after that $3 billion. But their free cash flow forecast for this year is negative $3.2 billion, then negative $3.7 billion, then about negative $4 billion. They lose money on every sale, but they make it up in volume. They did a great job at growing their revenue. In 2013, it was only $55 million, then $200 million the following year, then it doubled to $400 million in 2016. Then 3 years after that, it doubled again to $800 million. By 2021, it went to $1.6 billion, and it peaked in 2023 at $2.4 billion. It has come down to $2.1 billion. The investors have been losing a lot of money, but at least the CEO is making a lot more money. Her salary jumped from $300,000 in 2021 to $840,000 in 2023. Total compensation $14 million, tenure as CEO 3 years. Even the insiders do not have faith in this company. Everybody and their mother is selling the stock. You only see one insider buy in the past year, but the list goes on with the sells. Look how long this list is. Just people are selling, trying to get rid of that stock. 98% of the company is owned by institutions, 2% by insiders. The biggest shareholders, BlackRock, 18%, then Vanguard. Grantham, the Boston investment manager, owns 6.6%. Invesco, Amundi, the French asset manager. Handelsbanken, everybody knows Handelsbanken. Citadel, Fidelity, Soros, George Soros' fund. Their employee count has gone up a lot from 1,700 to 11,000. It did peak at 12,400 in 2022. And the ticker trades on the Nasdaq, Deutsche Börse, Xetra, Mexican Bolsa, London Stock Exchange, and Wiener Börse. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.